Welcome to another episode of the Three Seasons Podcast. I'm your host, Tyson Agasaka. On this podcast, we talk about the three seasons of wealth: accumulation, protection, and succession. On this episode, we have my guest, John Fisher, President and Chief Investment Officer of Bridgeport Asset Management, a private client firm in Toronto, Canada. And we're talking about what it is to be private client, how does private equity work, what are some of the features and benefits of using a platform such as Bridgeport, and much more.
All right. Everybody, thank you very much for joining us today. We're very privileged to have John Fisher from Bridgeport Asset Management on here. John's the president and chief investment officer and the original founding member. And so it's really interesting to have somebody on here from that side of the industry that's gone from the startup phase into the mature business phase. And you're in a really cool, like boutique private client investment firm. And you usually find one or two of those pieces. You don't usually find all of them put together, which is really a nice sweet spot. So John, thank you very much for coming on.
Great. Thanks a lot, Tyson. Really appreciate being here.
Yeah, no worries. So normally when I kind of have these chats, one of the things I like to do is find out a little bit of the origin story. Like how did you find yourself into this industry? And especially on the investment end, because you didn't start on the investment end.
Yeah. Yeah. I came to the industry, I think, with a little bit of an atypical background compared to sort of most people that actually get into the industry. Um, I started out life actually as a chartered accountant coming out of university. I did an undergrad business degree, like an undergrad sort of business degree here at like U of T. Went to work at a big four accounting firm. A couple of years later, became a chartered accountant. So actually, really early on, and we're going back a while now, like 30 years. Seems like yesterday to me, but it was a long time ago. I started out life doing public accounting, a little bit of tax. Found that a really useful background, but I very quickly moved into a different area of the big four accounting firm that I was at, which was corporate finance and also business valuation. So in that area, I spent a lot of time helping private companies, sometimes doing business valuations when they were looking to undergo a sale process, or if there was a shareholder dispute and one shareholder was buying out another shareholder in a private company. You sort of had to do a valuation because obviously these weren't publicly traded companies by and large. And so that was really my first kind of exposure to analyzing businesses, trying to figure out what they were worth. It was a very much in-depth type of process, deconstructing companies, tearing apart financial statements, trying to figure out what a individual company's future prospects were, how much money it might sort of make in the future, how you should value those estimated future profits. So it was a really interesting kind of background and kind of got me into that whole investment analysis, business valuation mode of thinking. So I spent 4 years at that firm. It's sort of now called PricewaterhouseCoopers, but it was a predecessor firm. And after that, went back to school for a year, did an MBA, like a 12-month MBA in the States. Came out and I went to work doing something similar. I worked at one of the big five banks with them in their investment banking department. So kind of doing something similar, but more focused in the Canadian public company space. Again, helping companies do public equity offerings, IPOs, getting involved with mergers and acquisition work. But again, for the most part, with larger public companies and a little bit more of that public capital markets experience. But again, it was all to sort of, tie it back to the same theme, very much involved analyzing companies, trying to figure out what they were worth. Obviously, if you're doing a public offering, you need to try to get a sense of the price you should be offering shares at to the public. So, similar types of analyses, just with public companies. Did that for a while. And then I went into an area at the time, this is now 1997, that was, I would say not too many people in Canada, was this on their radar screen, but I went into the private equity world and went to work for a middle market private equity shop here in Canada, Toronto. For those that aren't that familiar with private equity is really investing money into privately held companies. So as opposed to buying shares on a stock exchange, you're acquiring some level of ownership in a privately owned company. And the firm that I work for, which is called Clairvest Group, we would at the time typically invest in companies that were in more kind of traditional industries, service-based businesses, manufacturing companies. We invested in a couple businesses that operated casinos. So anything that really was profitable and growing and that we thought was an area that we could invest in, and hopefully, for every dollar we invested 5, 6, 7 years later, we would sell our ownership in the company and hopefully make $3, $4, $5 for every dollar. But again, it's a huge area now. I think there's something like $6 trillion of investment capital under management worldwide in the private equity asset class, so the ownership of private companies. Most of that money is institutional investors that are investing through fund managers in these private companies. So that's investors like pension funds and university endowments and really large family investment offices that have billions of dollars. But I did that for a decade at Clairvest Group, invested in all sorts of industries with Clairvest Capital and the capital from other institutional investors that wanted sort of Clairvest to sort of manage that money for them. It was super interesting. But again, the starting point is trying to figure out what industry there you want to invest in, and then trying to find individual private companies that have a use for your private equity investment capital. And sometimes the use would be to buy out existing shareholders. Other times the use would be to grow. The company had a particular growth strategy, but it required capital beyond money they could get from the bank or beyond the existing shareholders' personal resources. So they needed, outside money. And so, we would typically invest with a management team and our fellow shareholders that were running the business there for, a 3 to 10 year period. So real long-term investing, typically. This was not a thing where you invest and then you get your money back in 6 months. This is sort of invest and watch the money compound over time. So I did that for a decade, actually, 10 years, which was, pretty decent period of time. And then I started Bridgeport. That kind of brings us to Bridgeport, my firm. I started Bridgeport in 2007 at a pretty auspicious time. And then it was before the 2008 financial crisis.
That's right. Good
so
times.
yeah, that was my background coming in. I actually wasn't really in, to sum it up, I'd had a fair amount of experience doing investment analysis from different perspectives, as I said, whether it was investment banking, private equity, business valuation at a Big Four accounting firm. But what I hadn't done, quite candidly, almost 18 years ago, was I hadn't really worked in the wealth management field, and I hadn't worked too extensively in terms of, more kind of traditional investment management.
Right.
Yeah.
Okay. That's fantastic. I mean, what an incredible journey. And, now you're here and thankfully we get you and, you're not 80 years old and at the end of your career, you have a lot of runway left.
Yeah, hopefully.
And, yeah, I think so.
Yeah.
I really like what you guys are doing. And
Thanks.
so when you formed Bridgeport, the type of client that fits the model best, I guess in Canada, we would call them like private clients. In your opinion, kind of like what's the difference between dealing with like a retail client and like a private client, and how do we help people distinguish that difference?
Sure. we were really looking when we started to deal with clients that were looking for an elevated investment management solution. And I think that's really what we've been providing since we started the firm almost 18 years ago. So what does that mean, in my view? I think, at a high level, it means more institutionally or more institutional caliber investment solutions. So investment portfolio strategies that are being utilized by institutional investors like pension funds, university endowments, large family investment offices. And I think there's a few things that distinguish institutional investment strategies versus more retail-oriented investment strategies. One is the breadth of investment strategies that institutional investors allocate money to is much different than the types of investment strategies, or at least the breadth of investment strategies that retail investors typically find themselves invested in. And to be more specific, what I mean there is that most institutional investors today here in Canada, and certainly in the US and also globally, are investing into both publicly traded investment strategies, so what most people would commonly say, stocks and bonds, as well as private asset investment strategies. And so most people understand publicly traded investment strategies. They've got exposure to funds or individual stocks and bonds. But I find a lot of private clients, individual investors, don't necessarily know what private assets are, or they have often a more sort of limited kind of perspective on that. So it might be worth just explaining that. Private assets are, in their simplest form, are actually investments that are not publicly traded, which sounds a bit funny. So it's most investments that are not stocks and bonds. But so I'm explaining it in a negative way by excluding stocks and bonds, but more specifically, private assets typically include private equity, as I referenced earlier, so ownership of privately held companies as opposed to ownership of publicly held companies, which are stocks. Ownership of privately held companies where the equity or the ownership of the privately held company is not traded on a stock exchange. It also would include private ownership of assets such as real estate. So a real estate entrepreneur could say, hey, if they own an apartment building, that's a private asset. That's private real estate. And so it could be apartment buildings, industrial buildings, self-storage, any real estate asset category anywhere in the world would sort of be a private real estate asset. There's other categories such as infrastructure assets. So ownership of things like toll roads, like the 407 highway here in kind of Toronto, or ownership of a private ferry, or ownership of sometimes telecom towers would be kind of considered infrastructure assets, data centers, energy infrastructure, things of that nature. Those are long life assets that generate stable rates of return that are not always held within publicly traded companies. They're just private assets, and often you'll find pension funds and other institutional investors want to own those assets because they generate a stable rate of return and stable cash flow. And then finally, there's a whole category which people call private credit, or some people might call it private income. And that's just private assets that generate income that are not real estate. So usually they're lending strategies. So if you're lending money against real estate, and you own a loan or a mortgage against a property or a portfolio of properties, that would fall into that private lending bucket. You've also got loans to kind of private companies, as opposed to like public companies, and that would typically fall into an area called private corporate debt. And there's all different types of strategies within private corporate debt. And then there's a little more niche areas that are interesting and esoteric, like aircraft leasing. So, we have some investments with managers where they buy aircraft and they lease them out to airlines around the world. And the managers that we invest with are really collecting leasing income on planes that they lease out. We have another manager where their specialty is railcar leasing. They own, I think, now close to 100,000 rail cars
Wow.
that they lease out, to like railways and major shippers that don't want to own the rail cars themselves. So they lease out rail cars. Even more specific, we have some royalty strategies. So we have a manager that purchases publishing rights to songs of different artists. And every time someone listens to that artist's song on Apple Music or Spotify, or if the artist plays it in concert or it's in a TV commercial or a movie, we get paid as an owner of the publishing rights of those songs. So it's really a way to generate a return. You're getting that royalty or that leasing income or that interest income on a loan against real estate or to a company, or if you're getting dividends because you own ownership in a company, or you're getting a dividend from an infrastructure asset, you're really earning income in a way that's sort of independent, largely to what's going on with the stock and bond market. And so to bring it all back, why institutions want to invest in sort of stocks and bonds, but also these other assets, is they're trying to maximize their investment rate of return, but to do it with the most amount of like diversification and the least amount of risk and sort of volatility.
Yeah.
So they want to kind of diversify across all these different categories so they can get enhanced rates of return again, but hopefully reduce risk, reduce kind of volatility. So when the stock and bond markets aren't performing well, the other pieces of the portfolio are hopefully offsetting that, and they're generating more stable overall portfolio rates of return. And so that's sort of one of the key elements that we think that is part of a private client offering and a more institutional caliber investment offering to clients, is introducing all those different private asset categories. On the public equity, the stock and bond side, what we think marks a more private client offering, and what you see more institutions doing, is I think a couple of things, which is, kind of, I'd say 3 or 4 things. One is you want to be investing based on intensive research of individual companies, right? One thing that we do here is we have an investment team on the equity side where, our team is really coming out of an institutional investment environment, where they've been managing billions of dollars before getting here for large institutions. And, we really closely cover every company that we invest in. And, we're following the quarterly earnings reports. We are talking with the public company management and trying to figure out what are the best stocks and bonds to go into each of our kind of portfolios based on that research. But once we do that, we don't want to be over diversified. Like, one thing you see with some of the more retail offerings is a fund will own like 100 stocks.
Yeah.
And then you'll see a client with, 7 different mutual funds, and each mutual fund has 100 stocks. So indirectly, they're invested in 700 stocks. It's too much. You're not going to outperform and follow 700 stocks closely and get better rates of return and mitigate risks appropriately when you have to follow 700 companies. So we sort of think for every portfolio, about 20 stocks is kind of the right number. It's enough to get proper diversification in a fund, but we want to go with our best ideas, our best stock selection ideas. We don't want to end up with, like, once we're getting past 20 or so, like, why do we want our 80th best idea? Let's just focus our efforts on the 20 best ideas. And so I think you'll sort of see more institutional caliber portfolio managers. That's what they're doing. Like, it's not to say you want to be in only 5 stocks. That's not enough diversification, but you don't need to be in 400 either. And so we
That's right.
really want to focus our efforts on our best ideas. So when I think you put those two things kind of together, which is, high quality, research driven, publicly traded equity and bond strategies with a diverse range of private asset strategies, which is also global, you really end up with a portfolio that I think, gives an investor the best shot at maximizing their rate of return while, I think most importantly, also minimizing volatility, minimizing risk.
Yeah, no, that makes a lot of sense. I think something that we see in the industry, people come out with their specialized portfolio funds and whatever, and when you tear it apart, is like you can do that. And I've done it.
Yeah.
Is it reflects that closet indexing, right? It's just like,
Yeah,
well, you could have just bought an index and save the client a bunch of
exactly.
management fees.
Exactly. If you're going to put 200 stocks in out of the TSX 300, I mean, it's basically a closet index, right? You might as well buy an index fund.
Yeah, yeah, no, I agree.
Yeah.
One of the cool things that ties all of what you just said together, and was part of my introduction to the company, was the philosophy that you guys have. That's sort of the DNA that's woven through it, and it's the Yale endowment model. And
Yeah.
I thought that was really interesting because what they were able to do was, um, bring in not just that stocks and bonds and portfolio management, but really get into those separate asset classes. And that was something that really hooked me when I started talking with you guys, was that, yeah, there is a model that's out there, and somebody that's here in Canada is actually utilizing that model and utilizing it very well. And I don't think a lot of people know about that or have ever really talked about it in depth. Do you want to give like a little brief history of like what the Yale model was and why
Sure.
it's important?
Yeah. So the Yale model's been around since the late 1980s. It was really pioneered at Yale University. They, at the time, I don't have the number in front of me, but they had an endowment fund that they were managing at Yale. It was maybe a couple $1 billion, 1 or 2 billion. I think today it's over 30 billion, somewhere in that range. But a guy there by the name of David Swenson was the guy running that endowment fund at the time in the late 1980s. He recently passed away a year or two ago, but he ran that endowment for, 35 years or so, 30 to 35 years. And he really pioneered this endowment model concept of mixing both stock and bond strategies along with private asset investment strategies. And he did it super successfully. I think his rate of return that he compounded the Yale University Endowment Fund over that 30 plus year history was like about 13.5% compounded.
Wow.
Which, and I think he really did it while minimizing risk and maximizing kind of diversification. And he was really the first one to really heavily start to invest in all these different categories: private equity, real estate, infrastructure. And I think it's also allowed Yale and other institutions that started to copy it pretty quickly, to really weather through some of the storms that you've seen in the last 30, 40 years with the stock market, where they tend to lose a lot less money when the stock market's been down 20, 30, 40, 50%. And you look at the returns of these large institutional investors like Yale. And it's all visible. You can Google it. They all publish investment reports. Here in Canada, if you read the business section of any of the major newspapers, on a quarterly basis, they tend to have an article about how is our Canada Pension Plan doing, how is other large investors like Ontario Teachers Pension Plan doing. And what you see is in periods of stock market volatility, or more specifically, when the stock market isn't doing well, those investors tend to do much better because of their allocations to all these other asset classes. And very quickly after Yale and Swenson pioneered this, you saw larger institutional investors copy the strategy to, it's gotten to the point now where you'll see Canada Pension Plan, I believe, has 55% of their assets in the private asset world and only 45% in publicly traded stocks and bonds. And they're managing now, I believe it's close to $600 billion on behalf of people like you and me, and probably most of the people out in your audience. So whether people think they're invested in private assets or not, almost every Canadian is invested in private assets, just indirectly through the Canada Pension Plan. Ontario Teachers Pension Plan, one of the largest pension plans in Canada, very similar, probably close to 50% of their assets are also in kind of private assets. So it's a pretty time-tested, proven idea. The issue to date, and why we haven't seen a lot of individual investors and private clients invested, is it's been hard for them to access these asset classes. And we can certainly talk a bit about that more kind of later. But that's, I think, why, if you have people out there listening to this saying, oh, this sounds really exciting, I'd love to invest in music royalties and private equity. Well, but how come I haven't really heard about this all kind of that much? There's a lot of good reasons for that, but I think things are changing.
Yeah, I agree. The rise of the DIY investor and what they have access to is pretty incredible to watch, and it's also frightening from an advisor point of view.
Yeah.
I guess well, on the topic of DIY investors and clients, and they want to go out there and they want to piece some of this stuff together, buying the stocks and bonds and buying an index fund or whatever, that seems to be the hot topic I come across at least twice a week right now. It's like, why do I need this? I could just buy an index fund because, Instagram told me that's the way to get rich.
Yeah.
Is there access for DIY investors to buy a REIT or buy access to something that would be equivalent to, what a private manager is doing?
Sure. Generally speaking, access to private assets is extremely limited today to DIY investors. There are a handful of private asset funds available here in Canada that a DIY investor could invest in, but it's really only a small handful compared to what's available in terms of publicly traded stock and bond strategies. There's reasons for that. I mean, one of the biggest reason is most of the managers that manage these private asset strategies, so the managers that are in the private equity world that are investing into private companies, or managers that are investing into commercial real estate or infrastructure assets, or, for example, lending strategies like we talked to. Well, first of all, these are highly specialized strategies. So they require a fair amount of expertise from these managers to figure out how to source the investments, how to due diligence the investments, how to make the investments, and then how to add value to the investments once they're actually invested. So it's very different than investing in Google shares, right? As a manager or as a DIY investor, you invest into Google shares and you sit back and wait, and hopefully you've made the right decision. But you don't have any influence over Google. Or if you invest into Meta, it's not like you're giving Zuckerberg advice, right? It's very different. When you buy a building and you own that building, you're responsible for improving the value of that building, either renovating it or trying to lease it up at higher rates than you've leased it in the past, repositioning it, making sure that it's appropriately financed, and all these other things. Same thing with a private company. If you're a private equity manager working with a private company that you've now bought ownership of, Like you're working typically with the senior management team of that company and trying to figure out how do I expand this business so I can grow the earnings of this business. And ultimately, when you grow the earnings of a business, when you sell it one day, you're going to make more money. That's sort of the theory. But you're actively engaged with the manager of this business, every day, every week, every month, trying to figure out what's the strategy to grow this business. It's not a passive exercise, requires a fair amount of specialized skills. So what these managers to date have tended to focus on is they want to raise investment capital to invest into these private assets, real estate, private equity, like I said. They're looking for bigger checks from their investors. So they tend to focus on institutional investors. And somewhat selfishly, I guess you could say, and you can't blame them, is if I can go to a Canada pension plan, and Canada pension plan will give me an investment of $300 million. Why do I want to go to Mr. and Mrs. Smith and get a check for $50,000?
Yeah.
I need a lot of Mr. and Mrs. Smiths to add up to one check from an institutional investor of several $100 million. The investing that they do will look the same, but I want to spend less time gathering money from investors and more time focusing in on the actual investing. So that tends to crowd out or preclude private investors from gaining access to the best managers and the best funds, because they tend to want at least, depends on the manager, but usually minimums to investor $3 to $20 million into a fund that a private asset manager is managing. So look, let's face it, that precludes probably 99.9% of most Canadians who are going to say, I don't have $3 to $10 million to invest. And that's just in a single manager. And so if you want to put a certain amount of your money into, say, real estate, you probably don't want to give it all to one manager focusing in on one niche in one jurisdiction. So you might find a great manager who will accept $3 million from you, but they're doing apartment investing here in the kind of Toronto area. Okay, it's a good strategy. But that wouldn't be what Canada Pension Plan would do. Canada Pension Plan would say, well, I don't want to just invest in real estate in terms of apartments, and I don't want to just invest here in kind of Toronto because the market could turn here in Toronto. I want to invest on a worldwide basis. So I might want to do apartments in Paris and London and Sydney, Australia, and Austin, Texas, and all these other jurisdictions. And by the way, I don't want to just stick with apartments. I also like industrial real estate and self-storage, and I want to look at retail real estate. And then I also want to invest at different stages of real estate kind of development, everything from buildings that are trophy buildings where there's not a lot of work to do on them and they're solid investments and they're probably lower return, but there's almost no risk because the tenants are long-term lease and this is a trophy building in a city somewhere or a trophy apartment building. To I'd like to invest in someone that's going to construct a building of some type from scratch, where there's more return but more risk because you're building from scratch, to everything in the middle where it's an existing building, but it requires a little bit of a turnaround. It kind of requires a little bit of upgrade and light renovation, but because of that, we can improve the earnings of the building, the tenant profile, there's higher rates of return, and there's sort of modest risk. So if you put all those variables in, geography, stage of real estate development, type of real estate, you end up saying, well, I really need to invest in a whole bunch of different managers just in real estate, but I don't have $3 million times 15. And then if you do the same thing in private equity and lending to get all these different areas, like all of a sudden you need hundreds of millions of dollars. So how is a private client going to do that unless they're, a billionaire, kind of thing.
Yeah.
And so, we figured out how to do that on behalf of smaller investors, but, it's really an area that's, kind of emerging.
Yeah. Yeah. No, I think so too. I think that was a great wrapper, by the way. I mean,
Yeah.
it sums it up very nicely and it's very understandable. I think coming from, like, I was on the mutual fund side of the industry for 15 years and recently transitioned, but it's interesting to see that 5 or 6 years ago, companies were coming out with their liquid alts and they're
Yeah.
dipping a toe into it, except that a lot of mutual fund dealerships, they won't authorize the funds, even though the fund companies are saying, "Hey, we're
Yeah,
launching this, like here you go,
yeah,
whatever," and then we can't get it because it's non-compliant.
yeah,
Um, it's interesting to see the emergence, though it is starting to trickle down, but the way that you understand the way that you described like the umbrella effect of dealing with a qualified manager, it makes sense that hey, you're
yeah,
getting, fractional ownership in this larger pool of money,
yeah.
and that's how we're able to get the deal.
Yeah, exactly. When our funds allocate capital to these underlying private asset managers, we're typically writing a check of at least $5 million plus or minus, but often we're investing in a fund, you know, most often where we're investing in the same fund that pension funds are investing 50 million, 100 million, 300 million in. We're getting access to the exact same investments. It's just we're hitting the, sort of a smaller threshold to kind of get in. But what they won't typically take, it's changed a little bit, but they don't want 100,000 or 150,000. And you can kind of see why. It's just, it's easier to manage larger amounts of money. And then also, they're a little bit concerned just about the level of sophistication of a typical individual investor, putting money in versus into a mutual fund and dealing with them and making sure they understand what it's all about. And the fund structures differ quite a bit as well. We haven't talked about that yet, but the fund structures differ a little bit from what like a typical mutual fund. And the way the structures are put into place, they're geared for institutional investors. And so an individual investor or a private client would really need to understand what they're getting into as compared to a typical mutual fund before they go ahead and put money into most private asset funds.
That makes sense. Do
Yeah.
you see like sort of across the industry the barrier to entry? Do a lot of managers require that clients be like accredited investors, or is it just a certain asset threshold to say, hey, if you meet the threshold, then we can start to look at, having
Yeah.
you utilize the fund?
Uh, I'd say almost always to go into a private asset fund, you either need to be an accredited investor because they're generally offered via offering memorandum. So almost always you need to either be an accredited investor or work with a discretionary portfolio manager such that you have a managed account. And if you have a managed account that's being managed by a registered discretionary portfolio manager, you then don't need to be an accredited like investor because your portfolio manager qualifies under that accredited investor kind of exemption. So you're going to typically fall into one of those two buckets where either if you don't have a registered discretionary portfolio manager managing your account, you yourself would need to be an AI, or if you do have a discretionary portfolio manager, you don't need to be an AI because your portfolio manager is the sort of AI, so to
Okay,
speak.
that's nice. Um, we're seeing a lot of hype around some of these funds that have done really well in the last couple of years that have been really focused, hyper focused on the tech industry. And
Yeah,
the tech industry has really outperformed, especially in the last like 5 or 6 years.
yeah.
And as an investment manager, I just wanted to kind of get your generalized thoughts on, is this like a tech bubble 2.0, or are they at that point where they're too big to fail because somebody will just buy them rather than let
Yeah.
them fail? What are your thoughts on like where we are in the state of trillion-dollar valuations, like hyper performance, and where do we see the next kind of 10 years run out, do you think?
I'm assuming you're sort of talking more about Mag 7 like sort of publicly traded tech.
Those are definitely,
Yeah.
when you look at all of these hyper tech funds, they're in there.
Yeah. Yeah, I mean, certainly they've had a phenomenal run almost since the time I started Bridgeport over the last 18 years. I mean, I think there's some similarities between like the big tech companies, but they all also have pretty different business models, right? So
Yeah.
I won't be surprised going forward if you see some of them continue to be winners and others, maybe the business models start to get a little compromised. I think we see that over time. And in the past, like I think what people are forgetting about tech, um, is that by its very nature, like usually these companies need to evolve pretty significantly over longer periods of time to survive and thrive. It's just the nature of tech. And I guess the one thing we've seen is I don't think investors in the public market are always pricing that in. Like they're not pricing in the risks of, can these businesses like evolve? Like you take company like a Meta, just at a very high level, like I'm not certain, and I could be wrong about this, but I'm not certain a decade from now, you know, Facebook and Instagram, like people, are going to be wanting to use that to the same extent 10 years from now. That I wouldn't want to bet there's not going to be something new. There's going to be an evolution of social media and this way that we kind of connect with each other online. And um, Meta may evolve with that, and I think they're certainly aware of that risk, and it's why you see them investing billions of dollars in R&D for the next thing, whether it's into AI or into the metaverse. But there's threats, and I think you have to, that has to be encompassed within kind of valuation. So it's not to say that, you shouldn't invest in those stocks, and we certainly do. But I think what it goes to is you need to be thoughtful about portfolio construction. We talked about passive investing, and a lot of the indexes, like they're very heavily invested in those stocks, heavily concentrated, and it works really well while those stocks are going up. But if some of these risks hit home, you just want to make sure you're not overexposed to those companies. There's lots of other great companies in other industries, and I think it goes to making sure, particularly if like you're a DIY investor, that you constructed an appropriately diversified portfolio. And again, it doesn't mean 300 stocks, but it also means just because Meta or Microsoft or Apple have been great stocks to own, I don't know that, three stocks should be 50% of your portfolio. And I think sometimes you see that. And I think you particularly see it with like younger investors that haven't had the experience, and they just think these companies will continue to grow and prosper forever. And look, they may for the foreseeable future, but I think they're taking on more risk than they realize. And it could be kind of deadly, because you don't want to have a major financial setback with your portfolio when you're young, because of the compounding effect. It can really set you back. But I know that sometimes that message gets lost. I think particularly maybe on newer investors.
Yeah, no, I agree. I see that too. And unfortunately, I see it with new advisors too that come into the
Yeah,
space, and they sell the return based on, have a portfolio that's properly built.
yeah,
And some of them got caught a couple of years ago when there was a little bit of a pullback. And it is interesting to see that a lot of like what I do with clients and with our firm is we talk more about the risk, and it's like risk management.
yeah,
And we already know you're going to earn the income, you're going to do what you're going to do over a lifetime. But who's talking to you about managing risk? And I think that's one of the things that I
yeah,
love about the way you guys have built things is when we've done comparisons, hey, let's look at like portfolio A and then let's look at your portfolios. Even though it's more conservative, you might not hit the number in those highlight years. When we
yeah,
have years where it's pulled back, you haven't pulled back at all, and
yeah.
you can take less risk over a longer period of time and come out ahead.
That's where we really feel good about what we do. It's sort of a bit counterintuitive, but in a year like 2022, when like a lot of stock markets were down, depending which market we're talking about, but 15 to 30%, and bond markets took a hit because interest rates went up and a lot of bond markets were down 10 to 20%. I mean, because of the level of diversification between publicly traded and private assets in our portfolios, we really didn't take that kind of hit. And I think that really helps a lot of clients a lot, because when you hit those bad markets for stocks and bonds, people start to get nervous, right? And they're liable, notwithstanding advice from people like you and me, they're liable to potentially make the wrong decision at the wrong time. Because unfortunately, over 18 years, what I've seen is that when stock markets are bad and they've already gone down quite a bit, it's pretty rare that people are saying the stock market's a buy. Usually the majority of the opinion out there that you're reading in the media, because it's an easy thing to say, and it's nice because it feeds into fear and it gets more eyeballs and viewers and readers, is things are going to get worse. The so-called experts, a lot of them come on and they say, and I remember this in 2008 when I started, the S&P 500 had already declined close to 55% from the top of the stock market in '07 to the bottom in early '09. And I would say 80% of what I was reading and listening to and seeing was people in the media and experts that go on TV and everything else were saying, I think it's most likely the stock market will have again before it rebounds. So they were actually calling for a 75% decline from top to bottom in the S&P 500, the main US benchmark stock market index. They were calling for 75% decline when it had already declined 55%. And you know what? I got to be honest with you. It felt like they might be right. Things were pretty bleak. Like it just, the news was bad. People were talking about Royal Bank going bankrupt. There was a lot of fear. There was not a lot of light at the end of the tunnel. And a lot of people were fearful. They'd already lost a lot of money. A lot of clients, typical investors had already lost a lot of money. It's pretty easy for someone to say, you know what, I've already lost so much money, I can't afford to lose any more. And that's when they sell out. And they only know after the fact that they made a mistake. And then even when the market comes back, well, I'll tell you what everyone said in '09 when it came back. They used to call it a double dip. They said a double dip is coming. So we've had a bounce up, or else they call it, no offense to any cat lovers out there, they were calling it a dead cat bounce, meaning the market's come up a little bit. We've come back 10, 20%, but it's going back down again because the economy still has all these problems. Well, they were wrong. It didn't go back down again, but everybody thought it was. And so once you're into that mode, it's very hard. Whereas if you're more properly kind of diversified, it's not to say that you won't lose money, because unfortunately, when things are that bad, everything's going to go down, but you're going to lose less. You're going to have a lower dip. And we find that it means that investors are less likely to panic and can think about their portfolios with a longer term perspective. We will come out of this. There will be a better day. The Great Recession will recede. The pandemic will recede. I can start to think in 2, 3, 4, 5-year chunks, because my portfolio isn't down as much as the overall market. And I think that's really, really important. You could have Warren Buffett managing your stock portfolio for you, but if you're an investor that's going to sell when the market goes down and buy back when it goes up, I mean, even Warren is not going to do very well for you in terms of a rate of return. Like you can't be selling low and buying high, right? It's just the basic rule of investing. And people think they're going to figure out that market timing, and I don't think you can. And I've never met anyone that I thought could do it. There's just too many variables involved with it. Like I wish I could do it, but I don't think I can. Nor have I ever met anyone else that seems particularly good at it either.
Yeah, no, that's a great point.
Yeah.
Um, with yeah, it's I hate to go back and like kind of like unpack this, but like it was really disappointing to have that 60/40 type of portfolio built, and then we go into a
Yeah.
year like 2022. Stocks
Yeah.
don't work, bonds don't work, and now it's like, what are you supposed to tell the client?
Yeah.
That was a tough one.
Yeah, for sure.
And then all of our industry training, unfortunately a lot of advisors get training from the companies that produce the product and
Yeah.
don't seek outside training. And so they would tell us how to construct a portfolio and it's going to work, and 15 years of industry training and nothing worked, and nobody had an answer to why it didn't work
Yeah,
or what you could
yeah.
do. And it was like, man, that was frustrating.
Yeah. Yeah. No, I mean, look, I think there was some stat I remember at the time. I think we sort of wrote about it here, like one out of every, I'm going to get it wrong, but like stocks and bonds, maybe out of one out of every 10 years, they'll both go down in tandem. And you can kind of understand why, like interest rates going up in that environment will always usually be damaging to stocks because bond prices go down when interest rates go up. It's sort of the math of how bonds work. And usually, or at least in some cases, when interest rates go up, stocks will go down as well for sort of similar reasons. But that's really when the private assets come in. Like we saw that our private equity fund was up 8% in 2022, and our private credit or private lending fund was up, I think, 4 or 5%. So it kind of really offset some of the losses there. And of course, in our publicly traded equity side, again, because we're properly diversified, like we didn't have crazy exposure to those tech stocks that, the S&P 500, I think, lost 18% in 2022, but I think the NASDAQ was down like 30, and I think some of those big tech stocks were down 40 to 50.
Yeah.
They actually were pretty good buys by the end of 2022. But so people that like had that strategy of owning like the four, Mag 7, like probably lost like 40+%. Hopefully they held on through 2023. But again, they faced that thing, you know, again, how many market commentators at the beginning of 2023 were telling people to invest in the Magnificent Seven, all those big tech stocks? I'd say the prevailing market wisdom was to get out of those stocks, even though they'd already lost 40%. And it was wrong.
Yep.
They've done quite well since the beginning of 23.
Yeah.
So you don't want to be that in kind of that area where you're overexposed and you're chasing your tail and you don't know who to believe because you kind of made such a major bet that you're now don't know how to reverse it or get out of it, or staying in is such a risk. Like I find like you don't want to be in that position. It's kind of like it's really like you're gambling, you're at Vegas and you just moved all your chips onto one portion of the kind of roulette wheel, and or you've moved half of them on and you've now lost it and you're trying to figure out, should I double down? That's not good risk management, to your point. Like that's risky behavior. I mean, that you're getting into gambling versus investing, and that's not what we want to do here. And it's really not what we want to advise clients to do. And I'm sure you have the same view. I'm sure like that's just not going to help people achieve their long-term financial goals. It usually ends badly.
Yeah. No, I prefer the conservative approach.
Yeah.
And I sometimes you come across high speed clients that they want to, like, more, and they want, double digit returns every year, and they have a high list of demands. And it's tough to be the
Yeah.
guy that say that's not.
I've seen that over Mike. I mean, look, I've now got a 30+ year career investing in various areas, and I've almost never seen that end well, where someone, wants to sort of go all in on something in the stock market. I mean, look, it can work, but it's more luck than anything else. And I don't know if you want to entrust your financial future to luck.
Yeah,
So,
totally.
yeah,
No, that makes a lot of sense.
yeah,
I think we're getting close to time here.
sure,
But I have a couple of questions that
sure.
I like to ask is what book are you reading now, or what book recommendation do you have for people wanting to get more well versed in this area?
Oh, that's a great question. I'm not actually, it's funny. I don't always read a lot of business books. I do so much of this here.
Yeah.
There was a great book. It's funny. I haven't read it in years, but there was a great book I read a number of years ago, and it was a bestseller at the time. And it's funny, I just was rearranging some stuff on my shelf and the other day, and I was thinking about it because I saw it, and it's called The Millionaire Next Door.
Okay.
I don't know if you've heard of it or
Yeah.
not. Yeah.
Yeah, I have it.
Oh, good. Yeah, it's a great book, and I remember reading it like it's a while ago, but it really talks about the right mentality and habits to grow wealth. And it's a bit of a, from like what I recall, and perhaps you've kind of read it more recently, so you can comment in more detail. But it's kind of like a survey of kind of wealthy people. It's not always what you think. The people that are wealthy are not necessarily the people that you might think are wealthy that are driving flashy cars and doing all that stuff.
That's right. Yeah.
Yeah,
Yeah. It's funny. The wealthier families that I come across that you start asking them questions and you get to know a little bit about them. I mean, a
yeah,
lot of them drive something super conservative like a Toyota
yeah,
or a Lexus because they can drive it forever and not have to
yeah,
buy another car.
yeah,
And you'll just find like little ideas or philosophies that are sort of woven into their family
yeah,
DNA like that, where it's the value of something versus the monetary value of something, where like, hey,
yes,
I could buy this Lambo and I can flip it in a year and get in
yeah,
and out of it. And um,
yeah.
I
No,
think
that's it. I mean, I think the drivers of wealth are less complicated than some people think. And I think, maybe some people have a bit of an advantage in terms of the environment they grow up in. And those lessons may be imparted in their younger years more than other people. And so other people, this is, I think, unfortunate. It's again something more to be studied than I can. But they have to. Hopefully, they learn them, but they may make more mistakes along the way before they do learn them, and they sort of hopefully grasp them, but maybe later in life. Like, as everyone says, it's if you can learn them early and get started early in terms of building wealth, building a career, and not making bad financial decisions, those good decisions compound quite rapidly when you're early versus, if you start at 50 versus 20, there's a big difference there, as you and I know.
yep, definitely.
Yeah.
I guess last one that I ask is, do you have any good podcast recommendations? Anything that you're listening to right now?
Yeah, I do listen to a lot. So I'll give you two. It's funny, like the last year, I've started listening to a lot of podcasts on my drive into work. One, someone just told me about, I think it's a pretty popular one, but I hadn't listened to it. It's called Acquired, and it's about these two guys interview very sort of successful business founders. And I just listened to one. It was Howard Schultz, who founded Starbucks, and his story from the 1980s of how he basically started Starbucks. And it was just a phenomenal story, and all the trials and tribulations that he went through, and how a lot of people did not really believe in it at the beginning. He tried to raise, for example, some capital early on. He needed about $3 million, and he went to some major Italian coffee companies who were making, like sort of coffee equipment and espresso. And he told them his dream of bringing, Italian espresso-based coffee to the North American market. And they declined to invest with him, and they said, nobody in America is going to want to drink espresso-based coffee. It is just not going to work. And anyway, I find the podcast super inspiring. Another one that's sort of less investment based that I've been listening to is called Honestly, which is interesting, a little more kind of political, talking about just sort of what's going on in the world, various kind of political issues. And I find that's an interesting podcast as well.
Fantastic.
Yeah.
Um, was there anything that you wanted to cover that I didn't ask, or that area that we didn't get to?
Um, I'm just trying to think. No, I just want to thank you so much for having me on your podcast. I mean, I really enjoy working with you, and I've really enjoyed the kind of conversation. So I'm flattered that you'd asked me to be on, and honored to be here.
Fantastic. Well, John, thank you very much. I do really appreciate you as well coming on here, explaining what it is that you do and doing it so well. And I hope to have you back on sometime.
Right, for sure. No, well, thank you very much. Really appreciate it again. All the best.
Awesome. Thank you very much, John.
Bye-bye.
Thank you for listening to another episode of the Three Seasons podcast. If you're looking for more information on our guest today, John Fisher, you can find John Fisher on LinkedIn. If you're looking for more information on Bridgeport Asset Management, you could check out their website. It's bridgeportasset.com. And you can find a little bit about their portfolio construction. What are they investing in? How do they do it? And if you have questions, please feel free to DM me, leave me a comment, and make sure you like and subscribe.